Here's the first headline you've probably seen if you're paying attention. Spot silver prices have hit all-time highs. In late December 2025, spot silver surged well above $75 per ounce. And in some markets, it's even approaching the upper 70s as of the end of this year. That's not a small move. It's one of the strongest performances for silver in decades. And that strength is coming from a combination of several real, measurable factors. 1. Structural supply deficits are now multi-year. For several years now, the silver market has been in what analysts call a structural deficit, meaning global demand has exceeded total supply every single year for a long stretch. That has a cumulative effect over time. In 2025 alone, estimates show a deficit on the order of 100 million ounces or more, even with modest increases in mine production. The Silver Institute's data shows industrial demand continues to rise faster than supply can respond. This isn't short-term speculation. This is a real mismatch of supply and demand that has persisted and is now structurally tightening the market. 2. Industrial demand is exploding, not just investment demand. One of the biggest reasons silver is attracting attention is where demand is coming from. Silver isn't just being bought as an asset, it's being used at record levels in critical industries. Solar energy, electric vehicles, 5G infrastructure, semiconductors, and electronics all use silver because of its unmatched electrical and thermal conductivity. In fact, total industrial consumption hit record highs in 2024, and that trend is expected to continue into 2025 and beyond. More than half of all silver demand now comes from industrial uses, not from coins or investment products. These aren't speculative uses. These are real products that get manufactured and deployed. Once silver goes into a solar panel or EV component, it's not coming back. That material is consumed. 3. Macro forces. Rate cut. Expectations and safe haven flows. Another major driver right now is macroeconomic conditions, particularly expectations around interest rates. Markets increasingly believe the U.S. Federal Reserve will begin cutting interest rates in 2026, and that tends to boost demand for non-yielding assets like silver and gold. When interest rates go lower, bonds and cash yield less, and investments that don't yield interest, like precious metals, become more attractive from a relative standpoint. This shift has been helping silver catch a bid in global markets. In addition, geopolitical and economic uncertainty often pushes money into tangible assets. Silver benefits from that too, even though it's also a key industrial metal. 4. Geopolitical developments and export policy changes. Here's a very current development that is worth noting and something that's been trending in investor conversations. China is implementing new silver export rules beginning January 1st, 2026. These rules will require export licenses, which could tighten the global physical supply from one of the largest silver markets in the world. That's a real policy change, not a rumor. China controls a huge portion of the world's refining and distribution for silver, especially physical bars and industrial material, and anything that limits how easily silver can leave the country changes the dynamics of global availability. 5. Sentiment. Retail and institutional interest is strong. Another notable point right now is that both retail investors and institutions are paying attention. A recent survey showed that a significant portion of retail participants expect silver to trade above $100 per ounce in 2026. That's based on current sentiment and data, not pure hype. Analysts have also been revising forecasts and discussing how silver's fundamentals have shifted. That's driving more inflows into silver ETFs and more conversations in financial circles. It's important to understand that sentiment itself isn't the cause. It's a reflection of underlying issues, like supply deficits, industrial demand strength, and macro forces. But there are risks too. We have to be honest. While we're talking about what's pushing silver prices higher, it's just as important to talk about what could slow this down. One risk is that as prices rise, some industrial users may try to reduce silver content or substitute other materials where possible. That's already happening in solar panel manufacturing to some extent, where cost pressures have led makers to try to minimize silver use. Another risk is that prices sometimes overshoot on the upside before correcting, and precious metals are no exception. Volatility is part of this market, and price swings of 20 to 30% in a short time are not unheard of for silver. So while the current trend has momentum, it doesn't mean it's a straight line upward forever. So what does this all mean? Here's the key takeaway. The silver rally in late 2025 is rooted in structural realities, not just speculation. Multi-year deficits are tightening the market. Record industrial demand is consuming physical metal. Macro expectations, like rate cuts, are supporting precious metals. China's export rules could squeeze physical availability. Retail and institutional interest reinforces momentum. These are measurable and current drivers, not just headlines. Wrapping up, This episode was all about explaining why silver is acting the way it is today, what's behind the price action, and what real-world factors are influencing it. In future videos, we'll dig deeper into things like how silver compares to gold in cycles, what supply deficits really mean for prices, how industrial demand could shape mid to long-term trends, what role geopolitical shifts might play. If you found today's video useful, hit like, subscribe, and let me know in the comments what part of the silver market you want me to cover next. Thanks for watching The Silver Thesis, and I'll see you in the next one.